Good day, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Today is Monday. It's August 22nd. It's the third week of August, and September is right around the corner. Now, typically, August is a fairly neutral month. Not a lot happens, but this year is anything but typical. We're opening up with the Dow down about 300 points, NASDAQ down about 200 points. This is well beyond random. And actually, it's pretty well expected in light of all the upside action we've been seeing in the last couple of weeks. It's been getting a little too much too fast. Now, to give you some perspective on things that are going on this week, actually, let me go back to what's going on this week. We got a busy week. Today, not a lot goes on, but tomorrow we've got new home sales. That'll be an important report. The PMI will be an important report. Durable goods is going to be a real big report, but then you've got the big daddy, the GDP. This is the biggest report of the quarter, and this tells us whether or not the economy is growing or contracting or expanding. And as you can see here, we're not looking for much of a growth here. We're looking for 0.9, and it's between 0.9 and 0.2, so the range is getting a little tight, and I'm looking actually more for personal consumption expenditures. I want to see this number go up, but that's the expectation right now, 0.9. And it'll be very interesting to see what the annual rate for personal consumption is. I'd love to see this number go higher, and I'd love to see this number go lower. Aside from that, you've got personal income. That'll be very important. And then you've got Mr. Jerome. I'm not going to predict the future. Till I will Powell speaking. And then you've got inventories. It's going to be a pretty busy week. We're going to get more traction as we continue. Now, there's more stuff on the table. You've got earnings this week. You've got Zoom reporting, Palo Alto Networks. That's pretty important. These two are interesting communication stocks. I can't wait to hear what Zoom has to say. Tomorrow, you've got Advanced Auto Parts, and here's what they're expecting. You've got Dick's Sporting Good. That'll be interesting. You've got Intuit, JD, Nordstrom's. Oh boy, retail sales. Macy's. Ouch. Toll Brothers, that'll be very interesting. I think they might be close to bottoming out, and Urban Outfitters, so a lot of retailers. Then on Wednesday, you've got Salesforce. Here's what they're expecting. We'll get into this further in the week, about $1.02 per share, and Snowflake, a lot of tech. You've got Autodesk. You've got a lot of technology. You've got Guess, the clothing company, Splunk, Victoria's Secret. So you've got a combination. NVIDIA, right there. So, NTAP. So you've got a lot of technology and a lot of retail. It's going to be a very, very interesting week for the retail sector and for the home builder sector and for the communication sector, for the tech sectors. Keep your eye on the bond market because this is going to tell us whether we're going to go break lower or not. So far, we're in the range, and it'll be very, very interesting to see if bonds can remain in this range. I did get a chance to short it around the 120 level. I wish I got a chance to short it again, but now we're in this range. But so far, I'm not seeing it in a rush to go back down. I'm kind of seeing it choppy, which means we're in a wait-and-see mode, and markets should stabilize a little bit. With the volatility declining and the slope in the bond market declining, we should see more of that in the stock market. Now, volatility, as I warned you, and I'm long VIX, it started increasing last week as the QQQ and the broad market started selling off because, as I told you guys, too much too fast. We're bouncing off the 200-day moving average. This is very much expected. We gained a lot of ground here, and now it's time to pay the piper. QQQ, the IWMs, all of that should be cooling off quite a bit and coming down all the way back into this range. Now, one of the sectors that I'm watching very, very carefully right now, two sectors, and these are the two biggest ones in play, is consumer discretionary and technology, right? Very, very, very important. They both look like they're doing the same thing, and I warned you before we even peaked out this was going to happen. I told you it was going to happen. But here's what you need to understand. If you look at those two sectors, consumer discretionary, 19% of stocks are trading above the 200-day moving average. If you look at information technology and communication services, look at that, 39%. And communication services, all those stocks that are reporting this week, 19%. So 19 and 19. That's extremely vulnerable sectors. And in my opinion, both of these sectors are overdone to the upside. and they're going to be cooling off. Also, if you look at the Russell 2000, only 40 stocks are trading above the 200-day moving average. NASDAQ 100, 34. This is markets. This is emotion right here. So you've got to be very, 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 very cautious right now, especially with where we are right now. Now, I want to talk to you guys about something. Put the call ratio. We're still bearish. We still haven't gotten down. Every time we come up, we're still going up. So that means, and remember, the market rallied pretty hard, but put the call ratio is still favoring the bear. So there's still some potential for upside, but I would be very, very cautious right now because we're, again, getting into the bears being a little overdone. So be very, very cautious. And the whole market, it's a little wacky right now. In terms of sectors, you've got utilities and energies, but you've got consumer discretionary. And notice there's a gap between consumer discretionary and technology, fragmented market. When markets are fragmented, they need to cool off. On a monthly basis, you've got utilities, consumer discretionary, tech. We're all over the place. This market, if there's one thing that I know pretty confident, I mean, I can't predict the future, but I know is this market is fragmented and needs to cool off. And the fact that these sectors are so out of whack is telling me that there's a lot of vulnerability in consumer discretionary, communication services, and information technology, a lot of vulnerability. Now, here's what's interesting. If you look at the market, let's look at the heat map. Look at the heat map over the last few days. This is Friday. Healthcare, energy, utilities, consumer staples. Very defensive. Over the last month, consumer discretionary. This needs to cool off. Too much, too fast. Earnings were a little too positive in the near term, and this really, really, really needs to cool off. So pay attention to more downside this week. Let's talk a little bit about global economy. Oil prices fell by more than $1.50 a barrel. I don't think I'm not ready to give up the ghost on the energy market, especially with defensive stocks starting to rally again. If you look at the energy sector, if you look at the broad energy sector, you will actually see that it's breaking out right now. So I wouldn't be too quick to be bearish on it since we're going back up, and I think we may start really heading up. So let's get back into this. Where are we? Just when I start, it gets me off track. Investors are watching the annual Fed meeting in Jackson Hole, Wyoming, after minutes last week from central banks showed or affirmed the plans for rate hikes despite signals of a weaker economic activity. Actually, I disagree because spending is being strong. And if spending is strong, the Fed is going to interpret that as a green light to continue moving forward. Traders worry aggressive steps to contain inflation that's running at a multi-decade high might derail global economic growth. Very, very, very true. Chinese central banks cut its target from a 5-year loan by 0.15%. They're trying to do anything possible to stimulate their economy. The rate for a 1-year loan, which affects other industries, was lowered by 0.05% to 3.65%. They're doing whatever they can. Chinese, very different song and dance than they were singing a year ago. Chinese leaders are trying to revive economic growth without using across-the-board stimulus that might push up inflation or politically sensitive housing costs. Now, here is what's interesting. This is the small cap for non-U.S. or Canada stocks, and it started folding a lot before the U.S. stocks did, and it's still folding. And I think, look at this real quick. Look at that, and now look at the Russell. Small caps across the globe versus small caps here in the U.S. It's looking remarkably similar, as you could see that. And I think we're going to have a little more downside on tech and consumer stocks. I think earnings are going to be a little softer than expected, especially on the retailers and on Salesforce, Snowflake. It can go either way. So be very, very, very cautious. It's in terms of looking at individual sectors. Let me show you where the money is. I still like utilities. We're past that hump. Energies, we're not past that hump, but that hump was an all-time high, and we are past this hump right here. So I'm liking energies again. Consumer discretionary, I wouldn't touch right now if you paid me. I think we're going to cool off and go back into this range right here somewhere, into the 150s. Industrial, same thing as consumer discretionary. Technology, same thing. These three sectors, discretionary, industrial, consumer, and tech, down, back into this hump. I don't know about real estate. Healthcare, I like. I like how healthcare is right there and it's still moving sideways. I like how consumer staples is moving choppy and it's still not losing its place. I like how communication services are already cooling off. I think they may have a little more cool off to do. I don't know about financial right now. Things are not looking all that great right now. The only stability I'm seeing right now is in healthcare, energy, utilities, and consumer staples. The same stocks I told you that I was warm and fuzzy about over the last 2 weeks. Nothing has changed. Sentiment is getting a little more bearish, and I think we're going to start seeing the tech and small caps and all those stocks that have been running away starting to reverse. Now, folks, have you ever noticed after a stock has been down for 30 days or even 90 days, that's when a big bank comes after it to publicly downgrade it? It happens all the time. Interesting, right? After the stock is already down 30% or whatever, that's when the stock gets downgraded after being down for months. Now, they decide to downgrade after it's been down for months. That's when they say it's a good time to drop the stocks. I give up. So if you're thinking that sounds squirrely or fishy, then you'd really, really like Jeff Zananeri. So Jeff started doing some digging. And what he found out was extremely interesting, like really, really interesting. This guy's holding a workshop tomorrow, Tuesday, and he's going to tell you and show you why banks do that, why they upgrade, downgrade, their whole reason, logic for it, and how traders like us can potentially take advantage of it. I think this is very, very valuable info, and you can get all the details by signing up for this workshop through the link below. Follow now. If the link is not there, that means they haven't posted it yet, but it should be there. Follow the link, get all this now. And if it's not there, just check back in a little bit. This is red hot off the press. Follow the link below, do it now. I'll talk to you guys later. Any questions, feedback, love letters, whatever you've got for me, I can handle it. Support at marketgeeks.com. And post some comments in this video. They get lonely when there's no comments. Bye, guys. I'll see you later, and you have a great, great week ahead. It's going to be an interesting week for sure. Bye.